Okay, I think it's a minute past. Emily, do you want to kick us off?
Sure. All right. Well, welcome and thank you all for joining today for our live web conference. Today we're going to discuss City National Rochdale's economic and investment update. Today we'll hear from Chad Staskal, founder of Eagle Wealth Management, and City National Rochdale portfolio manager Rob Meckstroth. You're welcome to submit written questions during the presentation. To do so, use the Q&A box located at the bottom of your screen. We'll collect all the questions and answer at the end of the presentation. A recording of this webinar and the presentation slides will be available tomorrow evening on our website. And before I turn the call over, please note that all participant lines are muted during the presentation. So with that, I'll turn it over to Chad.
Well, good afternoon, everyone. Welcome, and again, thank you so much for joining us. I really appreciate you guys taking the time, whether you're live or whether you're watching this on the recording. Here at Eagle Wealth Management, we are so blessed to have so many great research firms that we work with. And we get so much information just from all these different companies. And if you guys have been watching the news, you probably, depending on what you're watching and which hour, you could be seeing something that says one thing and it seems like just a few minutes later, they're saying the exact opposite. Getting information is easy. Finding a way to try and pull all this information together and be able to present it in a simple way that can hopefully make sense to most people, that's the difficult part. And so as you guys know, and I've been working with City National Rochdale for probably about 10 years, you've seen a lot of slides and different presentations being put together. You may not have known it was City National Rochdale, but you're going to recognize their speedometers and some of the research that they do. Well, today I'm happy to introduce Robert Meckstroth. He's a portfolio manager at City National Rochdale. I talk to Robert almost daily. We are constantly talking regarding what's going on, different buys and sells, and you know what's best for each of our clients. Well, Robert and his team have been through numerous bull and bear markets. And I just want to start off. I want to ask a few questions to Robert because I think this is a great time and a great opportunity to kind of just bring this back a little bit to where we're at. But Robert, this has got to be one of the most interesting and challenging economic times that you've seen. How are you feeling with everything going on?
Well, you're spot on, Chad. And first off, thanks so much for everyone taking the time out of your afternoon to talk with us today. Like Chad said, this has been such a unique year, from the election to the COVID crisis and the market crashing back in March. And I do think this is probably the most challenging year that I've faced 16 years in the business. And that includes the crash of Lehman Brothers and 2008, 2009, which was, you felt at the time was a once in 100-year event. And this crisis is just so different. It's really what we call an event-driven crisis. The COVID outbreak has, affected so much of the world, but the impact has been more heavy in certain sectors. Yet other sectors of the economy may be in better shape now than before the crisis. And that's what has made this so challenging, is that it's not like 2008, 2009, where everything was down. You need to reduce risk, get out of the market, and then wait for things to come back. This has been such a fascinating year. And then throw in the election and where we're at now, which we'll talk about in a minute. And, there's a reason why 2020 is a year that most people are looking forward to being done with. But we do have a couple more months to go. So hopefully there's no big surprises in store for the season finale of 2020.
That's what you need to tell us, isn't it?
Exactly.
Robert, as we kind of go through this, I find a lot of our conversations very interesting because you and I kind of share stories, and we talk to our clients about their portfolios every day. And I know you're talking to, actually, we talk about a lot of the financial planning. You're talking to so many different families, different advisors. I'd love for you to share, what's some of the best things that you're seeing people do, and what are some of the mistakes you're seeing some people doing coming from, the portfolio manager side?
Yeah, that's a great question. And I mentioned this is a year like no other, but there are certain things that are very common for any type of financial market crisis or downturn where I think you ask people who are doing things right, it's those who really have worked with you on a financial plan, have looked very far long-term and come up with financial plans that take into account possibilities of market crisis, and are prepared for these type of years ahead, where you don't need to react emotionally or in any other way to get in and out of the market. You stick to that financial plan. And we see it time and time again. What happens in late March when the markets are crashing? I'm not fielding too many calls from investors looking to invest money when panic and fear is at its highest, but I'm fielding call after call from clients who are very worried that want to get out of the market at times when times are the worst and markets are down. And history just shows over and over again that those really the most worrisome times when markets are down are usually the best buying opportunities, and at least opportunities just to hold the course. So the mistakes that I see are people that want to react to market movements and kind of shy away from those long-term plans. And then another set of mistakes, I think this is starting to happen almost every 4 years, is the political environment is so heated and we are caught up in the day-to-day news of all the uncertainty around the political environment that we're always worried about the downside with election. And again, I fielded numerous calls from clients looking to get out of the markets, get into cash ahead of the election, and not too many calls asking to buy ahead of the election. And it's funny, if you've heard us speak over the last few months, we've been pretty adamant that we didn't feel like the election was going to be a major driver of the stock market and the economy, regardless of the result. And we'll talk about that in a minute, some of the logic behind that. And then you've seen the result kind of play out. We've had the first 10 days of November be one of the best market periods in some time. It's early reaction to the election, but it's positive. So kind of to sum it all up, don't react to politics as much as you might want, and think of those financial crises as more of opportunities rather than times to sell out and abandon a long-term financial.
Well, it's good to react by focusing on how you're going to possibly change an election. But when it comes to your stock and bonds and investment holdings, that's somewhere you don't want to react when it comes to an election.
Yeah. So good stuff.
Well, hey, on that note, I'm going to turn it over to you. I'll maybe jump in here at a time or two, and then I'm going to let you go through a little bit of your guys' research and analysis, and then we'll take some questions at the end.
Yeah, excellent. Thanks so much, Chad. And I'll dive into things with just some of the developments this week that has changed. And if you were following the news, you probably couldn't miss it. We had the Pfizer vaccine announcement earlier this week that came as a big surprise to the market. And the biggest surprise was that 90% effectiveness rate in that trial, which sent shockwaves, around the world from a market standpoint. Because if that vaccine ends up coming through at that efficiency rate in the end, that could be a real game changer. Markets reacted. I'll have some more details in a second on that. We're not out of the woods yet with that vaccine. The phase 3 trial is still going, but a big positive. At the same time, we're dealing with a real big jump in COVID cases in the near term. We have some stats that I'll go over, but we're back to very close or past prior peaks in both the US and Europe. It doesn't look pretty out there COVID-wise. And Europe has already moved forward back to large-scale restrictions. And in the US, we've done some targeted restrictions, but we might be very well headed, if nothing changes in the next couple weeks, to some more larger scale restrictions. And I'll go over some of the economic impact there. Despite COVID, the jobs market has continued to improve, but the improvement in jobs is slowing down, a more moderate pace. And that's to be expected given the surge in COVID. Income and savings. There's some fascinating information on income and savings and how that's affecting markets. Savings is still at very high levels, as is income, but more stimulus is likely needed. That's why those stimulus talks are one of the top financial headlines. And probably one of the negatives around the political environment right now is it's caused additional stimulus talks to pretty much be held off until most likely sometime in January. But even though the stimulus talks have been negative, we have a lot of clarity on the election result. We're looking at a Biden presidency with a Republican Senate, unless the Democrats were to really shock with these 2 runoffs in Georgia. We're looking at a split government, and that tends to be pretty good for markets, as you can see from the early reaction. That's some of the real-time updates this week. To dive into some of the information, we title this chart "Vaccines Becoming a Reality," and we already had some news earlier before the Pfizer that we had positive news out of the Oxford vaccine, positive news on the Moderna vaccine, and those continue to be optimistic as well. So we're looking at a potential for multiple vaccine solutions, different types of approaches, and potential emergency use authorization as early as next month in some of these. So we do expect some of these vaccines to start getting rolled out, maybe to healthcare providers first by the end of the year, and then full availability probably sometime into 2021. So a lot is riding on these vaccines. Again, I mentioned that we're still in the later stage of the trials here, and you can see by the market reaction this week, if positive news comes in on these vaccines, it's going to be a big boost, and the opposite's going to be true if we get some kind of setbacks along the way. That's something that we're following very closely, and probably why I decided to lead with these charts, because of how important that vaccine is going to be. And this kind of just sets it on a timeline, the same information. And I think my most important takeaway is, we're probably not going to have a return to normal until we get a full broad vaccination, which is in a very optimistic scenario. We're looking at late Q1, early Q2 to have this vaccine widely available. And that's banking on this getting distributed fast enough, produced fast enough, and also getting the American public on board with taking this vaccine. And I think at the moment, we're a little discouraged by some of the polls that have showed about 50-50 on willingness to get a vaccine early after it's released. And we do think those numbers are going to go up once you get through the trials and it's pretty clear that these vaccines are safe. And I think if it means, getting to see your grandchildren again and getting back on a plane and being able to go on vacation, I do think people are going to start to sign up for these, especially if these Pfizer numbers hold true. I mean, if you have a vaccine that get 2 shots and it's a 90% effective cure, sign me up on day one. I'm ready to get back on vacation. And I'd imagine that there's a lot of others there. But we will need significant amount of education, because the vaccine is only as good as the number of people that take it. And the bottom line is we're still going to be dealing with COVID for a while now. So that was kind of the optimistic part of the presentation. Now we're looking at some of the pessimistic information, which is the new cases, hospitalizations, and fatalities. You can see this chart, daily new cases back to all-time highs. And it's very discouraging to see this, because we kind of have heard this all along, that we were set for another rise in cases in the fall. And, as a country, I don't know if we best prepared for this as best as we could, but now we're in the heart of it again. Hospitalizations tend to lag a little bit on the cases, and unfortunately, those are rising. And then fatalities as well. And fatalities tend to be the biggest lagging signal here, and those are coming up. So depending on where you are in the country, the Midwest is really getting crushed right now. Places like North and South Dakota have levels of COVID that are kind of New York City levels that were back in March and April. So it's not encouraging. The near-term impact of COVID is definitely going to have an economic impact. So our bigger challenge is try to figure out, how do you position yourself when, kind of 6 months from now, you're looking at a lot of optimistic data, but in the middle of where we're at now, there's pessimistic news with COVID. We'll get into that in a minute. So Europe was looking pretty back in the summer. This is Europe's COVID cases and fatalities. And what you saw in June, July, August is, really good control of the virus. And then, as we've seen play out time and time again, as you reopen countries, as Italy, France, Germany, UK, got back to normal, the virus is just set to accelerate again and has. So, this ties into our investment theme, in that we aren't invested in Europe, and the fact that COVID is back with authority in Europe means that that investment approach is going to continue. Not a lot of opportunities to invest in Europe, and they're kind of just with us dealing with a new rise in the crisis. Now, what this is Oxford puts out this COVID policy stringency index here. And what that is kind of a measure of how locked down economies are. We have Western Europe and the United States, and we know in March and April was kind of our peak level of restrictions and lockdowns and stay-at-homes. And then we started this reopening process both here in Europe. And the reopening trends basically continued up until now, where we're seeing this big surge. So Europe has already started imposing some more broad-based lockdowns, whereas here in the US, we haven't fully gone that direction. We've seen certain states start to act, like New York City, San Francisco, starting to restrict indoor dining again. You see a state of Maryland is doing similar. A state of Ohio just came out with a few policy approaches. So you're going to see more restrictions likely in the US, but I don't think we have the desire to go back to the full lockdown status that we had in March and April. That's going to be a positive as far as the economics are concerned. I think we've learned a lot from this, from where we were in March and April. It seems like despite some headlines showing people not all complying with this, for the most part, people are comfortable putting on the mask, going out and doing what they need to do with the mask on, and using the social distancing and doing that as opposed to the full lockdown. And we're seeing a lot of evidence to support that outdoor activities with your mask on are much, much better than these indoor activities with no mask on, which tends to be the super spreading type events, like what happened in the White House a few weeks ago. So it does make sense that if you're going to implement policies to kind of think about those indoor activities, focus on bars and restaurants, and try to hopefully keep things like schools open that may be safer and may have bigger ramifications if kids can't get back to school. So it's going to be a hurdle with those restrictions. And when we start looking at the job impact of this and unemployment rate, we talked about a nice improvement. We went from 14.7% unemployment back down to 6.9%. So we've continued to see jobs recover, but you can see this line is starting to get a little less steep and is likely to kind of flatten out here at about 7%, because we've gotten a lot of jobs back outside of the COVID sectors. But when it comes to airlines, hotels, restaurants, bars, cruise ships, casinos, theme parks, Disney's probably not in a hurry to hire back all those theme park employees yet. We're probably going to have to wait a little bit until COVID really goes away. So it just shows how important that stimulus is going to be in the near term to bridge that gap. One of the things we watch internally is permanent job losses versus temporary layoffs. The dark blue line here is temporary layoffs, and you see, that's what has come back significantly. But the discouraging thing is the permanent layoffs that are starting to grow. We really haven't had a dent in those. So again, getting those stimulus payments in, helping businesses that are most effective to try to prevent these permanent job losses from accelerating is going to be very important. And we do think that stimulus is going to happen, but unfortunately it might have to wait till January, till we get this whole election behind us. So this is one of my most favorite topics right now, which is looking at personal income and savings. This is one of the more important themes, I think, when trying to project our economy. So what this black line is personal income. So in the trillions as a country. So look at before the crisis, our personal income as a country was right around that 19 trillion mark. But look at personal income ever since COVID hit. Personal income is higher than it's ever been. And that personal income increase was all about the government support, the additional $1,200 stimulus checks, the enhanced unemployment aid. That temporarily boosted personal income. And as that stimulus wears out, the income starts to go down. But still, you'll notice that personal income is higher than it was before the crisis began. So this isn't necessarily the same for every individual, but on average, our savings rate as a country has improved because of this. A lot of us have seen increases in our income and no real changes to our expenses, maybe even less expense than we had before, with no travel, with no gas spending, with a lot less mobility. So fascinating, you're seeing credit card debt decline in this crisis. You're seeing the average credit rating of Americans go up. And obviously that's not true for everyone. There are people that are very affected in those COVID sectors that are in bad shape. And that's why it's so important that the stimulus gets directed to those that aren't benefiting from this crisis and are in bad shape. And again, we think it'll happen. So, going into the election stuff, we have a very strong likelihood of knowing what the result is. So we're looking at a Biden presidency. We still see the president not conceding the election yet. We see it playing out in the courts, but we've spent a lot of energy on this internally to look into all the cases that are ongoing and see if there's any chance that there could be any change in result. And we think the odds are minute based on everything we see. So everything is lining up that Biden will take office January 20th. And very likely he has a Republican Congress, a Republican Senate to work with during the first couple years of his presidency. We have the 2 runoff elections in Georgia that will determine the control of the Senate. If the Democrats really pull the upset, which I'd say internally we have the odds around 10% of that happening, so very low, then the Democrats would have full control. So what this slide shows is the economic impact of this current state. So Republican Senate, Biden presidency, and right out of the gates, the market has loved this result. And why is that? When you look at personal taxes and corporate taxes, these are likely to not be changed. The Trump tax cuts are likely to remain in place. You're likely to see corporate taxes stay low, no real changes to personal taxes. And that's obviously going to be good for markets when you allow companies to keep a greater share of their profits. At the same time, we're still forecasting positive spending ahead. Despite the Republican Senate, I think there's an appetite for more stimulus. This COVID crisis has been just too damaging to too many small businesses and individuals to not continue the stimulus. So we think that's going to happen just a couple months delayed. And we think that the Fed, and I'm going to have Chad cover this in a second, is one of the biggest drivers of positive economic forecasting that we could see. And we think the Fed is going to remain very accommodative. So I won't go through quite all of these, but we think the total economic impact of this political result is very positive. And what's funny is, even if the Democrats pull the upset and take back the Senate, we would still have the overall economic impact as positive. The only real big changes that would be is you'd have the economic impact of taxes go to red, and the economic impact of spending probably go to dark green, as the Democrats are likely to spend a bunch more money on stimulus, which would kind of artificially inflate corporate profits in the short term. So we're not going to go too much down that road because I think it's a low odds scenario, but just know that we were positioned for that type of outcome ahead of the election. And we think portfolios are built fine to withstand a Democratic upset in January, even though we don't think that's the likelihood. So I'm going to turn it over to Chad after this slide, but we look at the government result not only from a policy standpoint, but from a sector standpoint. And I'd say the only sectors that we think are negatively affected by a change in president is the banking sector and the energy sector. So I think you're likely to see more environmental regulations on energy. Energy's been a tough place to invest with a lot of those companies down 50%, and it might just get tougher. So I doubt you see us buying any oil and gas companies at all over the next 6 months, with tough conditions still in place for energy. And banks are going to be in a tough position too, because they're fighting low interest rates, which aren't good for banks to begin with. And then if you increase regulations on banks, that's not going to help from a profitability standpoint. So when it comes to all the different sectors, it's really more of avoiding financials and energy and being pretty happy with everywhere else with this political result. So I'm going to pause. It'll help give my voice a break to turn it over to Chad to cover the next one. So take it away with this one, Chad.
Well, Robert, thank you very much for going through this. I really like this slide, and really what it kind of comes down to is it ties in probably to the question that I get the most when I'm going through the financial plans. Once we get past talking about what was going to happen in the election, but it's what is the disconnect between where the stock market is, where we're seeing still record highs here just this week, yet millions remain unemployed. It's like we're seeing just thousands of businesses, small businesses going out of business, yet the stock market is going up. And when we look at it, there is a disconnect, and because the stock market is not representative of where our economy is. The stock market is more looking to where the economy hopefully is going to be in 12 months. And so when we're looking at that and we say COVID, as Robert really tied in that very beginning, is COVID was more of an event-driven recession, depression versus what we saw with the mortgage crisis back in 2008. And so we do see that looking forward with the vaccine that, the stock market's going up because we're saying, hey, in 12 months, we should have a vaccine. Hey, in 12 months, we should be starting to see the full opening of a lot of our economy. The second thing that really has driven it, and I think it was shown so well in that prior slide, is that the fiscal and monetary policies of all of these, U.S. and global banks pumping trillions upon trillions of dollars into the economy, almost to the point, and as you saw in that previous slide talking about incomes and savings, there's actually was an increase that because they put so much in because they were so concerned about the fact that our economy was going to come to a stop. So that has been a huge help with pushing and keeping our stock market, on track and looking at the long term versus just where we are today when we're seeing so many companies going out of business. One of the other key factors I think that's lost, especially when a lot of people look at the S&P 500, which is 505 of the U.S. Stocks that kind of represent our economy. They think, hey, dollar for dollar average the economy in the stock market with the S&P, they should mirror each other. Well, the issue is that 39% of the S&P 500 is made up of technology companies. Well, technology companies have done well, actually probably done better than expected because of the fact of what happened with COVID and pushing everything more digital. But only 6.9 or just less than 7% of our actual economy is driven or produces income or produces to the GDP by technology. So again, 40% of the S&P 500 is technology, yet only 7% of our economy really is tied to that. Inversely, 19% of retail and of industries impacted, which is the retail, the hotels, the tourism, the entertainment. 19% of our GDP is those service industries, yet that represents 7% of the S&P earnings. So these companies that are these industries that are really getting hurt really have taken effect. But again, it's not an apples and apples. So we're seeing those companies, especially the large companies. The S&P 500 is made up of larger companies. And so because we have those larger companies, those are kind of taking a lot of the profits from those companies that were either forced to shut down and or are just struggling and can't maintain based on they can't build that digital infrastructure they need. But again, coming back to the biggest part of it is obviously in the market, the fiscal relief from Washington and around the globe that's really pushing. You can kind of see that's really driven it. So I like to kind of come back into that because I think that's probably one of the biggest disconnects that we get. And this really ties in directly. I've had this conversation so many times, but all these slides are really kind of tying into it's a different conversation as opposed to saying, hey, what's going to happen to the stock market when the election happens or what's going to happen when COVID's done. Those are parts of it, but another big part is there's so many other outside factors, and that's why we love doing this part. So I'm going to let Robert get back into it, but again, this is when you kind of see this stimulus, and we're probably expecting, as Robert said, no matter what happens with the remainder of the election, we're going to continue to see another stimulus package come in. It's just how big. And that is going to be another driver to push that stock market forward, which I'd say, I'm assuming, Robert, when we see that next stimulus package, are you expecting that to be another pop for the market? Or is that, do you feel like that's already part of where we're at?
Yeah, I think, if we got a stimulus package before the year end, the market would love that because it's pricing in that a stimulus package is going to wait. and it's pricing in that the dollar amount of the stimulus is going to be a lot lower than if the Democrats had full control. So if Mitch McConnell and Biden can work out a $2 trillion package in January, the market will probably really like that. If the stimulus comes in at $1 trillion, that's kind of probably what is being priced in. And if it's under that or doesn't come in, that probably will have a negative effect. So that's why you see a lot of the headlines about those stimulus talks, because they're so important. And yeah, he did a great job going through this slide. I'll just remind everyone that this is just the funds injected by the central banks. So this is just the central banks across the world. Everything deployed by Congress is just on top of this. So this isn't even including the $2 trillion that was already deployed through the CARES Act. So it just goes to show this has been an unprecedented government response from a financial standpoint to fight this crisis. And that's helped get us out of this more quickly than if the government hadn't acted financially. But this is going to be a big theme and going to have major investment ramifications, which will end the call today talking about where we see some opportunities to take advantage of these trends and where we might see some of the risks. So we just got this updated with speedometers through November. So most of you who have heard me speak before have seen these charts. If you haven't seen these are one of our most, I think, popular reports, because it's a collection of 20 indicators that we think look forward 3 to 6 months. And I just mentioned the next 3 to 6 months are a ton of uncertainty. And I couldn't wait to see these come out, because I was speculating without talking to my research team to see if they would finally upgrade the political environment from red to yellow with this result. And they're toying with me because they upgraded it, but just to the edge of the red. They didn't have the courage to go all the way into the yellow. And I predict it's because of still the legal challenges that are unfolding, and the fact that we do have 2 Senate runoff races. So I expect as we get into January, after those Senate runoff races, that we actually might see the first upgrade in the political environment in years. These have been red, as far as I can remember, at least the last 4 or 5 years, we've had a red political environment. And maybe we're going to finally see an upgrade there. But I don't want to focus too much on that, because I think these core economic slides that I'll highlight here are the ones that are far more important for the direction of our economy. We've talked about a couple already. This is the last slide we just looked at with central bank activity all the way to the green. This is what we've already talked about with Congress, fiscal policy, being very positive, injecting money, but you can see the gray arrow represents where we were the month before. So 2 months in a row, we've had a slight downgrade of this indicator the longer the stimulus talks go on for. But 2 big updates this month are both the leading indexes and corporate profit growth indicators have moved into green. And what that indicates is that we're starting to see some positive trends out of corporate America. Corporate profits have bounced back. We saw a significant portion of the US market report third quarter earnings that exceeded expectations. So many companies had disastrous second quarters and rebounded in the third quarter much faster than expected, and have provided some positive guidance. So on average, companies are looking pretty good. The 2 most important indicators that we talk about are the labor market, which we talked about a little bit. This has stalled out here in yellow because we haven't been able to increase the number of jobs at a fast enough rate. The unemployment rate has come down to 7%, but unlikely to change very much from there until we get past COVID. And consumer spending is kind of flattened out too. We looked at the income slide that showed the stimulus money is wearing out, and consumer spending is very directly tied to income. So there's some positive news out of corporate America. There's positive news on the government response from a financial standpoint, but we're stalled out as far as a lot of the consumer goes. So when you add up our economic view, I'd say the word is cautiously optimistic, that we're happy that we're going to continue to see growth in the economy. It's just going to be a lot slower than we have. But it's important to remember is we're not calling for things to turn back the other direction. We don't think we're going to head into another recession despite the surge in COVID cases in the near term. And one of the reasons for that is a significant portion of our population is in just such good financial shape, unlike what happened in 2008, 2009. And a good place to look at that consumer shape is the housing market. You can probably look at your own house and see, go to one of those housing price sites and say, hey, my house value looks pretty good. And you see that across many metro areas that the housing market is exceptionally strong. It's benefited from lower interest rates. Lower interest rates definitely help housing. And that's not consistent with a major recession. That housing market is at an all-time high in many places. So it's just reflective of strong consumers in many categories. Again, if you're in the COVID sectors, it might be a different story, but if you're not, you're probably looking at a higher savings rate, income that might not be changed, and now lower interest rates, which are going to be a theme of a couple of the final slides I'll cover, and what the ramifications are for lower interest rates. Fantastic if you're looking to borrow money now. If you're looking to buy a house, interest rates are as low as they've ever been. Tough if you're looking to save money in a conservative way. Just try going to the bank and looking at the CD rates now. It's not a pretty sight. So with that said, I have a few more slides to cover. I'm going to go a little quicker through them because I want to make sure we have time to answer any questions that have come in. A lot going on in this slide that has our forecasts for the economy and a few other things. I'm just going to focus on next year. Not going to talk too much about this year. But next year, you can see we have a growth expectation of 3.5% to 5.5% for the U.S. economy, despite COVID accelerating. And we have a corporate profit growth forecast of 20 to 40%. So this goes back to Chad's point that the stock market is not going to be looking at the current reality. The stock market is always forward-looking. And if you think the outlook for the whole year 2021 is going to be positive and companies are going to grow earnings at 20 to 40%, well, that should bode well for stocks, especially when interest rates remain low. So we think the Fed funds rate is going to remain low at 0 all the way through the end of the year, and that the 10-year bond will also remain low. That has big ramifications. All else equal, that makes you want to own stocks if you have positive economic outlook, corporate profit outlook, and lower interest rate outlook. One of the questions I do want to just cover for a minute is inflation risk. And I get a ton of questions on inflation because it often goes, hey, with all this stimulus and debt and Fed activity, are we just going to put ourselves in a heavily inflationary environment? And it's a good question. I think if we do continue to spend without any checks indefinitely, we're likely to head into a potential inflationary environment, but we don't see that happening in the near term. And I think with a Republican Senate, that even cools down our inflation forecast even a little bit more with less potential for spending. So, we focus all on this one when it comes to inflation. We talk about higher debt and thinking that that's going to be a big driver. But we don't focus sometimes on some of these other things that tend to be deflationary, such as increased retirement age and aging population, technology. Heard me speak about this before. Technology is an exceptionally deflationary force that keeps prices low. And slower economic growth, which we do think is going to happen, just means less inflation globally. So not to go into too much more detail, but we don't think inflation is a risk in the near term. But that said, inflation has been running so low that I wouldn't be surprised if we do see a little bit of increased inflationary pressure to maybe 1.5%, 2% over the next few years. And that would have ramifications if you're invested very heavily in conservative investment. And going into that question, we talk about the Fed rate policy. Look at this: 2021 forecast, 2022 forecast, 2023 forecast. The Fed is likely to keep interest rates at 0 for a number of years still. And again, that has ramifications across the board. Specifically, if you're investing money in cash or short-term bonds, you're not going to get anything on those assets. So you have some incentive to look to higher risk areas of the market. And that's one of the things we do as a firm is try to find opportunities outside of those safest assets to get a little more bang for your buck without taking maybe as much market risk as just dumping everything into stocks. So again, it's supportive of risk assets. When interest rates are low, all else equal, that means every dollar of corporate earnings should be valued at a higher rate. So there's a fundamental reason why risky assets should do well in a lower interest rate environment. And it really just has to do of each dollar of corporate earnings being more attractive. So one of the themes I do want to hit on before we wrap up is this year has been exceptional in that, look at the performance of the top 5 tech companies through the end of September. Apple, Amazon, Facebook, Microsoft, and Google were up 41% through the end of September, pulling the whole market up with them. Whereas other categories of the market, small cap stocks, high dividend stocks, companies outside of the top 5 tech companies are down 2%. You see those headlines, markets back close to all-time highs, but that's not the entire market. That's really the technology stocks. So we're seeing some opportunities maybe in other sectors. And if we do get that positive vaccine news, that day was fascinating when you look at market performance. And it ties into a little bit about this, which is speculative emerging market tech stocks due for a correction. And what are speculative emerging tech stocks? Well, think of companies like Zoom and Peloton and DocuSign, these technology companies that have benefited from the COVID situation that have gone up, close to 200% on the year. What happened when Pfizer announced that vaccine trial? Zoom was down 20%, Peloton down 20%. And it gives you an insight into a lot of these high-flying tech companies are not necessarily in great position when we do get past COVID. So when we look to growth, we want to avoid those stocks. I think it's great. If you picked up any of those stocks before the pandemic, it's been a fantastic move. But based on their performance over the last 6 months, their valuations are starting to get very steep. So we see a lot of opportunities maybe outside of some of those COVID themes into high quality companies. And when we start talking to you about your portfolios, you'll see some of those stocks that we like right now. So I think we're good on time for one more slide here and there. I'll try to wrap this up in a minute. We talked about this. Here's interest rates. This is the 10-year interest rate. Look at how far interest rates have fallen over the last 40 years. I mean, it's incredible. The government bond, 10-year government bond pays 0.8%. 10, 15 years ago, you could put all your conservative money in government bonds, collect 5% and call it a day. Now you're getting 0.8% for those same securities. It's just not going to pay the bills going into government bonds. So where do we go instead of government bonds? High dividend stocks, very attractive. When you compare them with growth stocks, there's a big difference in their valuations right now. And you see high dividend stocks have had a fantastic week post-election, post-vaccine news. So this is one sector ready to jump. High yield municipal bonds. If you're in a high tax bracket and you're looking for bond-like investments, a lot of attractive high yield muni bonds that we see. And the return you get over those government bonds is significantly higher. And for those of you in high tax brackets, you'll see us use these high yield muni bonds and maybe even consider using more down the line. And the final point I'll make is just, investment grade bond returns have fallen with these interest rates. So when you look at investment grade municipal bonds and investment grade corporate bonds, you used to be able to get 4 or 5% out of these categories. That's now 1.5% and 2%. So I mentioned instead of owning investment grade municipal bonds at 1.4%, we can look at high yield munis at 4.6. Instead of investment grade corporates at 2, we can look at high yield corporates at 5.5. Obviously, there's more risk here, but depending on your ability and desire to take risk, there are some opportunities out there. But again, some investors still may see attractive reasons to own corporate bonds at 2% due to the safety they provide. This is a safe asset. And again, if we think inflation is only going to be 1.5%, you still can make money in the bond. So So Chad, I'm going to turn it over back over to you and Emily to see if any questions have come in, and we'll try to answer all of them if we can in the next 15 minutes.
Sounds good. Emily, you want to jump on?
Sure. Thank you, Robert. All right, I'm going to get to questions. First one, you briefly touched on the housing market, but what about a general tanking of apartment rents in urban areas? Is this a factor to pay attention to? And if so, what might?
Yeah, great question, and definitely a factor to pay attention to, because if you're looking to move into downtown San Francisco or Seattle or New York City, I mean, now's a great time to do it, because you're seeing rents drop more than they have in the last 10 years in some of these cities, because it's been the opposite movement. But then again, try looking for apartments around the suburbs of these places. Here in the San Francisco Bay Area, try going up to Marin County and look at a nice apartment there, and you're seeing rents at record highs. So you've definitely seen the weakest housing markets across the country are those urban areas. Everything else is where you're seeing a lot of people move into. So when you're investing in, like if you're looking at apartment type investments, and we own a couple, you want to be hesitant to look at apartments maybe in those type of areas, but probably okay in more suburban areas or other metro areas. Like give me some apartments in Arizona, Colorado, Montana, as those states are seeing just a lot of new residents and some good opportunities there.
Yeah, I'd say it's very regional, as you said there, Robert. I mean, here in Bend, we're at a pretty much a net zero rental opportunity, and rents just keep going higher and higher at a level, just because it depends on people trying to get out of the urban area. Do you feel like that rents probably might turn back around in the urban areas once COVID has cleaned up a little bit?
Yeah, absolutely. I think the death of New York City, I think, is being prematurely called, because what happens when we get past this virus? Young people are still going to want to live in New York City. Young people are still going to want to move to San Francisco. Offices are still going to open up in these places. Are they going to be back to where they were pre-pandemic? It might take a couple years, but I do think those areas will bounce back, once we get past COVID.
Okay. Recent science indicates there's about a 20% chance that by 2024, global temps could exceed the 2.7 limit that activates unstoppable climate impacts. Even if Biden cuts emissions, we're close to a serious disruptions in ecological, social, and economic systems. What can we do to prepare for this?
Yeah, that's a great question. I think that's a question we're asking too when it comes to looking at portfolios. I think that's something that we're going to be dealing with for the next decade, and we're already starting to see the signs, right? When you look at the impact of climate change. I mean, here in San Francisco, we're now dealing with an annual fire season. I mean, it's just something that we're dealing with on an annual basis that doesn't seem to be changing. Clearly, climate change is probably behind a lot of that, and trying to figure out where investments need to go and what areas might be very negatively affected by climate change, I think is going to be maybe the most important investment question over the next 4+ years. And you already start to see some of the investment decisions, naturally being made for you. And example of that is, when you look at some of the energy production stuff, like when you look at utility investments and you look at some of the renewable energy, you've seen a surge there in that type of investing. And I think that's been, part of what we're looking at when we look at utilities there. So, I don't know what the right answer is to, how this is all going to play out, but I just can assure when we're watching it very closely and, almost take it 3 to 6 months at a time. But I think if you're, as far as climate change goes and preparing for it, I mean, the Biden administration has talked about that, right away in the transition team. That was one of the core goals, is to address climate change and rejoin the Paris Accord. And, it's easier said than done. I mean, you can talk about it and the actions taken might be difficult, but there clearly is at least some desire to take that on from a presidential standpoint. So we'll see how it plays out.
Hey, Robert, because I know obviously we talk quite in depth a lot about social screens and environmental screens and things like that. Has there been much change? Because I talk with lots of clients about, investing in solar and investing in water and investing in some different renewable areas. You want to go, how is City National Rockdale looking at that? Because I know it's been obviously one of the more volatile and risky assets, which sounds kind of crazy. And on the other side of it also is possibly not investing in some of those areas like fossil fuels and things like that. And also, I don't know if you can change it to make it so that it's just the videos. You probably can just look at that now.
Yeah. Well, sorry, what was the last part about the video?
Can you change it just to be the videos to get rid of the, I was going to say, you probably just look at the videos as opposed to this one last screen.
Oh, yeah. I get what you're saying now. There we go. Yeah. So, so on the social screening front, so first I'll talk about just some of the natural moves that we're making. And I mentioned it during the presentation that oil and gas and fossil fuel investing has been the worst category to be invested in this year. It's been a disaster return-wise, and we don't own a single one of those companies for people who don't want to own them and for people who would allow us to own them if we wanted to. So we really have no desire to invest in that space, and I don't see that changing anytime soon, that those companies are going to bounce back and be what they once were. It's going to be tough because on the oil and gas side, you have two issues. One is that the technology has improved, so the supply of oil and gas is at all-time highs. And now the demand is going down. So the demand for oil is plummeting. You have states like California that are making plans to outright ban gasoline combustion engines, in fairly near future. You look at the 2030s, a complete ban on gas vehicles. And again, trends like that are going to start to play out across the world, making oil and gas, primarily a bad investment. So, as far as our social screens go, I mean, we have some of those type of investments naturally in the portfolio where we think they're companies that are going to stand out. So like on the utility side, NextEra Energy is the #1 utility as far as renewable energy is concerned. They use more renewable energy than any other utility. And that's not the reason we own them. It's just that they're really good and profitable. And what's great about that is renewable energy now can be profitable for these utilities. And that's a good trend. So it's very encouraging from a social standpoint that we can find some of these companies that benefit from renewables, and we think they're the best in class companies that are going to be the highest profit engine. But then some of the companies have seen, with these funds that specialize in social investing, certain investments have gotten way out of control valuation-wise. Like solar energy stocks just look very expensive. So we don't like them because of their valuation. They can be really good companies, but we don't want to buy them just to buy them if we think the stocks are overvalued, could come down. So clients that do want to go into, looking at some more environmentally friendly or socially responsible stocks, we can have those conversations, have some options. But I'd say right now the portfolios, I don't see any huge oil and gas polluters or anything major at the moment in a lot of the portfolios we build out.
What about wind farms?
Yeah, so Ventus out of Denmark is one of the best wind companies in the world, and Paul Erik Olsen, who runs our office, is from Denmark and loves the company. And it's just like, the company is so expensive because everyone wants it. That's from a socially responsible standpoint. Fantastic company, great execution, very clean energy, very expensive stock. So that's what I think a lot of the wind power stocks are. I think of the Danish company because they're the world leader in wind.
All right, we have one more real estate question. Are we seeing REITs or real estate as a good place to invest in the market? Seems like it could vary by region.
Absolutely. So I'll give my thoughts, and Chad, you have a lot of experience with the REITs too, so I'll have you chime in. But as far as the REITs that we're buying right now, is we're thinking outside the box a little bit. We like REITs in some interesting spaces, like cell phone tower REITs, for example. With 5G rollout, there's REITs that specialize in cell phone towers that lease out those towers to wireless carriers, and think that's a great investment. Data center REITs, again, those REITs are only going to get more and more popular as Facebook and Netflix and Amazon need to store all their data, so you can find REITs in that space, like industrial and warehouse REITs. So there's a couple of these different themes that we're investing in for clients that are outside of the traditional retail and kind of apartment and office REITs. The one area that I'm the most negative on is probably just that, again, those urban core type REITs that are focused on office space or residential in San Francisco and New York, because it might be tricky. Those are up 30% in one day with the Pfizer vaccine news. You can see how exposed those categories are to COVID.
Yeah. Well, I think that's a great question. Honestly, I take it past regional, and just like you were kind of hitting on, it's really much more about the sector. I would say, I would still, like you said, apartments. I mean, with the values of houses going up so much, that's going to have to push rents up as well. So apartments, I think, are still good. I think, you're still going to need grocery stores. You're still going to need some of those strong areas like that. Obviously, the older shopping malls, like you were saying, in the urban areas, the older shopping malls, the times are changing now. We're not going to see that as much. So I would really kind of say that I don't think I don't think commercial and going to an office is dead. I think there's a lot of more productivity coming into the offices, but I definitely think that coming into this recession, and I don't know if you guys think differently, but we were not overbuilt in commercial real estate. We were not over leveraged. We weren't like we were going into 2008 where there was so much office space. Yeah, we're at a point now where it's definitely, it's a lot easier to go digital and to work from home, and we're all seeing that right now. But there has not been much new building, and we weren't overbuilt to start. So I would say on that, it's probably going to be still a solid longer term investment, but you are seeing more volatility as we have with real estate. Real estate is actually pretty good value right now because it was hit so hard during this recession with COVID, because everyone's going to the tech, and they basically left banks and real estate and utilities for dead. So that's kind of my feeling on it. Yeah.
All right. And if there are any more questions, feel free. We have another couple minutes. And if not, feel free to email your questions to info@MyEagleWealth, and we will get back to you.
Right. Well, hey, Robert, thanks so much for your time. Thank you for just kind of putting it out there so that we can kind of get a good education and just being a resource for our firm and our clients. I really appreciate it.
No problem. This is always a lot of fun. Again, thanks again for everyone joining and listening to us this afternoon. We really appreciate you taking the time and love doing this, and look forward to catching up with everyone again soon.
All right. Take care, everyone.